is Buying Miami, Life, Love, and Real Estate. And I am your host, JoAnne Jones. I'm a second-generation Miamian, and I am obsessed with real estate. And also living your best life here in the best city, Miami. Okay. Ladies and gentlemen, we are back with another episode of Buying Miami. So this is season 2, episode 2. I'm always just amazed that we've come this far. I looked back the other day and I realized that I did 16 episodes in the first season. And I'm like, well, that was a little heavy. I think I might just go with 8 episodes this season. Mm-hmm. But anyways, I'm very excited and interested in the guests that I have today. I have Berko, who is the CEO, and I have Marika Dzhindzhikashvili, who is the COO of Astor Realty Capital. And what they are is a real estate fund that you could invest in and get a pretty handsome return on your investment. And the reason why I was interested, because this is a little outside of traditional residential real estate, right? But it's kind of a difficult market right now. I don't know if you guys have noticed, but we have high interest rates. We have low inventory. In South Florida, we have high prices. And when you have someone, there's different buyers. There's buyers who are end users who need to buy a piece of property to live there. And then I also have a very large segment of my sphere of influence who are real estate investors. And all of my real estate investors are just kind of sitting on the sidelines because it doesn't pencil out right now. I mean, to buy a multifamily or a duplex or a triplex, it's just, or even to buy a shitty little apartment in some little city and try to rent it out. It just, even though rents have gone up 30%, it's just between the high interest rates, the down payment, the taxes, the maintenance, the insurance, it's not penciling out. Even to get a 4 or 5% cap rate on residential rental, it's challenging. So what do these buyers do? Their money is sitting in the bank. It's not making anything. And they want to invest. They might have a couple $100,000. I have a client right now. He just sold a property and, he's hesitant to buy another property because of all the reasons that I already stated. So what are the alternatives? And what are the alternatives for the common folk, just normal people who really don't know what to do or where to go? And I came across your opportunity, and I just wanted to learn more about it because it's interesting. There's not a lot of companies that I know of that do this. And so I wanted to have you guys on the show to just kind of explain to, first of all, who you are, where you come from, how did you get into this business? I have so many questions. And then what exactly is the opportunity and how does it work? So I don't know which one of you want to start, but let's just jump into it.
Pleasure. Good to be here, and always great to see you, JoAnne. So let's maybe go to the origin of where we started.
Okay.
I'm the founder and CEO of Astor Realty Capital. It's a company that I morphed out of the advisory business that I had for many years in New York City. For about 20 some odd years in New York, I was representing family offices, large funds, public companies, even the state of New York and real estate matters for a good number of years, close to 20 years. Around 2014, I decided that the market is shifting, the industry is shifting, and so I morphed the company into private equity, where I decided to be an advisor with skin in the game. And so over the course of the last 7 years, we've teamed up with a public company that has become our major backer. We've built up several hundred high net worth friends and family club of investors, and we've embarked on acquisitions across the United States into major markets where there's employment growth, positive migration, pockets that have been super interesting for us to invest by deploying that type of capital alongside best-in-class operators on those specific markets and those specific asset classes. So today, you'll find in our portfolio, which spans over 7 states, 12 major markets, over 3.6 million square feet of quality real estate that, for the most part, is getting ground up construction between multifamily, lots and lots of multifamily, condo projects, lifestyle hotels, primarily in very specific and very strategic areas such as Scottsdale, Arizona, and downtown Miami, logistical centers, and anywhere in between.
And I'm also very big on making sure that everything that we do, I'll get into the background a little bit, but I'm also very big on making sure that everything we do is very, very holistic and very focused on advocating for all our investors and everybody that comes and joins us and is alongside with us. That's a very big culture for our company. So my background is from Eastern Europe, and I'm versed in multiple different languages. And when I joined Astor, I realized where they were heading, and I definitely wanted to be part of that and the family that was built into that company, and learning from such a professional. My role in the company as the COO is, of course, making sure that everything runs smoothly in the firm that has so many different arms in multiple different locations. So those areas are always leadership focused, as well as making sure to maintain all the institutional relationships that we have, whether it's on U.S. market or international market, whether it's on the capital side or deal origination. I also focus on working with a very large team, and I have a large woman investing club as well. So that's a part that I'm very passionate about, and we're just making sure to build our firm on strong foundations, and our fund is definitely in a very strong stage of growing and attracting more partnerships that are institutional as well.
Well, it's, people are scared to invest, and they're afraid to lose their money. So, having one thing I liked about you guys is that I could actually meet with you in person. Yeah. You're local. They are based in South Florida, in Miami Beach, where I'm at. And there's one thing to just be able to meet someone and feel their energy. Yeah. I'm very energy centric, so I just, and I'm intuitive, so I just like to meet people and understand, do I like them? Do I trust them? Because at the end of the day, obviously there's a rule that says don't invest any money that you can't afford to lose. But guess what? People invest money that they can't afford to lose. It's not the smartest thing to do, but there's a lot of emotions around money. And when I think about my aunt, who has X amount of dollars, and she's worked, for the school system for 20 years, and she's about to retire. And, my dad comes to me and says, hey, where do you think she should invest her money? I have to be very careful, because I can't recommend anything that, listen, there's always the chance that she loses her money. But, if she does, it's coming back on me. Yeah. So to be able to, I kind of like that small town kind of feel that you guys have, although you're dealing in very big worlds and in big circles, but you're accessible. Yeah. I can meet you in person, which is, in this day and age, it's very important. Okay. So explain to me, because we don't have a lot of time. It'll be amazing how fast 20, 30 minutes goes by. So in a nutshell, tell me about your opportunity, why it's good for common people to invest, and some of the pros of it. I already know what the pros are, but I'd like to hear it from the horse's mouth. So JoAnne, I just want to touch on what you just finished saying. And, when you said about the accessibility and the point where you spoke about my aunt, I would say that is one of the portions from our side, right? Yes, we do have the institutional and all of that, and
and it's so amazing to have access to that, right? So that was part of the reason why we started. We wanted to include our friends and family. That was a very important part for us, to make sure that they too have access to those institutionally vetted product, institutional size. And a lot of times it's hard to get into those type of deals with specific type of check sizes. So we wanted to make sure to make that available for our friends and family. So my mom can invest, and our close friends can invest as well and join us. And you've mentioned local. We do have a headquarter in New York. We have a large team there as well. So we're pretty versed, and we do have a robust team as well that supports our operation. So yes, we are local, but we do have multiple different locations here and in New York, and we can jump into the opportunities that we have.
So since we don't have much time, I'm just going to say it in one word. It's called collective bargaining. So really, what's the concept? The concept of collective bargaining is essentially you, the small investor, who's coming in with a check. I'm just going to throw a number, $100,000, stepping into a project or locating a project that you find interesting. Who's out there making sure that the project is going smoothly? Who's out there making sure that money is not moving to where it's not supposed to move, that things are on time and on budget? The collective bargaining portion of what we do essentially changes the outcome of the game quite often. How? We look at around 800 transactions a year. As a group of professionals, like Marika have mentioned, we've been around the block for quite a long time, right? We have a group of analysts and people that are in construction administration and all sorts of different things, all sorts of disciplines within Astor Realty Capital. Whenever we choose a project, it's because we vetted about 800 projects and said no to most, about 98% of them, for a variety of reasons. So the choice of project that will bring to the table the opportunity is going to be very different, and probably at a better quality than the ability of, let's say, somebody who's not a privileged professional to choose a project. That's the first thing. I think it's very important. Secondly, when we show up to a project, we typically bring the vast largest check. We are the major investor, as much as 80% of total equity at times. Our ability to negotiate terms, not just for us, but as a collective to all of our investors, is entirely different than if you show up to this project and go directly to the operating partner or the developer himself. And so we'll get better terms, which means more returns to you in your pockets, better project, and very importantly, not only we go through a rigorous due diligence process, usually a 60-point due diligence process that touches the legal aspect, the market aspect, the asset itself, the underwriting. Not only we assess the risk, we also have backup plans. If the market shifts, if we're building condominiums, can the project hold water? If the market goes down, can I rent it? Can I keep my head above water? Preservation of capital is the most important thing for us. Like you said, we work hard for our money, all of us, right? Most of the folks that show up at our desk, and there's hundreds and hundreds at this point, and it's been building up organically, have all been working extremely hard for their money, and preservation of capital comes first. So working with us, end result is you'll have a partner that with a skin in the game, a group that is interested or representing your interest, not the interest of the developer, making sure that it's the right project, making sure that the negotiation puts more money in your pocket, and vetting throughout the entire 3 to 4 year of the project or 2 years of the project, making sure that things are going according to plan. Now, if they don't, in the world, sometimes things happen, you have a group of professionals that can step into the project, remove the existing developer, take over, replace him, finish the project ourselves, and make sure that we are on top of everything. So it changes the tango. It changes the dynamic. And I think that's why we're being called disruptors in many different aspects. The other thing that you've touched is the friction. Today's world, investments are done frictionless. You go to your bank, you do it online, you put money, you buy the stocks, you go to a crowdfunding site, you see a nice presentation, you send the capital, you sign everything online. We're not like that. We are very, very much focused on understanding what our investors are looking for, what's their aspiration, and making sure that we have conversations. We are accessible, whether it is on a face-to-face meeting with myself or the best team that we have available to us. We make sure that we get on the phone on individual conversations. People have all sorts of questions, concerns. There's, the concept of friction is great if you're building up a tremendously large group of investors, all with small capital. Our structure is a little bit different. I want people to know us. I want them to know that we're accessible. And perhaps that's why every investor to come on board, after a short period of time, we see two things. A, they put a lot more money with us, but the second investment, third, the fourth. B, it's a long-term process. Once you build that trust, once people start seeing the returns, it becomes a very long-term process. The trust is being built. We trust them. They trust us back. And lastly, we get a lot of referrals. Every one of our investors tend to bring family members, friends. People talk about us. And you know what? It feels great. And I think maybe that's the Astor Realty Capital difference.
So let me get this straight, because some people might be listening and be like, what the heck are they talking about? So let's back it up a little bit. So what
often happens, yeah.
Astor Realty Capital is a real estate investment firm where you can come in with what you would probably put on a down payment on a piece of property. So let's say $50,000, $60,000, $100,000, $250,000. But you can come in with what would be considered smaller amounts of money. You could, and what they do is they look for usually multifamily. So maybe they're building a 300-unit multifamily rental or condo building. In fact, you're building
Correct.
One in Bay Harbor, right? How many units is that?
Actually, the one in Bay Harbor, it's going to be a boutique project. It's a condo and it's a boutique project. But typically, we do institutional-sized projects. Like you said, 300 units, 150 units at a minimum, depends on different markets. Rental projects, not just multifamily. It's really across the gamut. When we go for condos, we've had condo projects that are over 100 units. The one in Bay Harbor, in particularly, it's an 18-unit project, and I think it's going to be gangbusters.
Yeah, that one is, I know about that project. Who is the sales broker on that?
I have not made that allocation just yet. We have some folks in mind, but we're still in that process.
Okay, so I'll have to talk.
We haven't started with the marketing.
I have to talk to you about that offline. But so they take projects and they pull the money. And so, maybe you put in $100,000, and what they do is they pull the money and then they go to the project developer and you kind of do construction loans, right? The developer needs X amount of dollars to build the project.
Yeah, so we deploy capital to projects in 3 different strategies. Strategy number 1 is teaming up with a developer, becoming co-GPs, if you will.
GP is what?
As general partners.
Okay.
Or LP, limited partners, and having a general partner, and putting the capital in as investors, as co-owners of the project.
Yeah.
The second way to do it is through preferred equity position, which means we'll have equity in the project, but we're going to exclude or diminish the risk associated with the project because our money will be returned back sooner or prior to all the other equity. I don't want to confuse things. It's called preferred equity. And then lastly, we sometimes come in as debt. We sometimes come in as the funder of the project from a standpoint of debt. So we'll be like the construction loan. We'll invest the capital as the construction loan or the renovation loan. Now, maybe to make it simple, I'll give an idea of how it's different, right? So assume, JoAnne, that one of your clients says to you, hey, I got $500,000 to invest. I'd like to put it into real estate. My stock market is going this way, that way. It's a whole casino up there. Nobody knows if it's coming up, down, or sideways. And I've heard that real estate investment sounds a really good thing. So what's the options? What's the availability? The chances are that you'll offer them a $2 million apartment, possibly in Miami, right, where the market is on fire, even though it's been slowing down, but it's still a very solid market. And chances are that apartment will be leased out eventually because you're great professionals. You might say to them, hey, let's furnish it. Let's lease it out. We'll be able to get you a 4% on your money. providing that everything works out great. What is working out great? Basically, you lease it up. The tenant will pay on time. The tenant will not mess up the apartments, all sorts of different things. And if everything is aligned perfectly, you'll make about 4% on your money. Or let's look at another alternative. You have $500,000. What I would say is consider investing with Astor Realty Capital in 5 different commercial projects. Project number 1 could be maybe 300 apartments that we're building in Dania Beach right now. It's 293 apartments, right? Mm-hmm. Project number 2 could be maybe investing into a condo project that we have in Bay Harbor, right? Mm-hmm. Where the returns are projected to be north of 20% a year. Mm-hmm. Project number 3 could be maybe investing into, a hotel project that we are, that we're currently building with a wonderful group in Scarsdale, Arizona. Project number 4. So that's the idea. So you create your self-diversification. Don't drop all your eggs into one basket. And then you create yourself a nice diversification. Each and every one of those projects essentially will generate what we're doing today is around 21% return net of fees. So 21%, that's our average today. Not too bad considering the market is what?
It's almost unheard of.
8%, 7-8% right now, the capital markets. Last year, I think people lost around 10 to 15% on their portfolios in the stock market. So that's our average. Keep in mind, every deal is, pays off in about 3 to 4 years, 2.5 to 4 years. And so what we do is we make a right allocation, and that's an alternative to buying an apartment in Brickell, let's say, for a couple of $1 million, taking on a mortgage, signing on personally, doing all those different things. Mm-hmm. And that's where we're investing through a real estate fund is different.
Okay, so let's say they have $100,000, they invest with you, they make 21% annually. Is that how that is?
Annual return.
Annually.
Yes.
So then that $100,000 turns into $121,000, for example's sake. And then how do you determine, or how is the term of the $100,000? How do you determine how long they're going to be investing with you?
Right. So what we do is we choose a project. Let's take a specific project right now. We have a project in Dania Beach, 293 apartments. We've entered the project in middle of 2021. We're probably going to exit sometime next year or maybe late next year. Our position is preferred equity. And so our investors are their capital is generating a certain amount of return on an annual basis. That amount gets accumulated until the exit when we sell the asset. Now, how do we project that? Every construction has a life cycle. We know when we start. We have an indication of how long it will take to build. We have an indication of how much it's going to cost to build. And we have an indication of what the market is going to absorb with some deviation, right? We always kind of go conservative so we can be sometimes pleasantly surprised. And so we enter in 2021. Investment goes in. Projects commenced. We're now getting close to completion. A certificate of occupancy on that particular project is slated for March of 2024. It will take an extra 6 months to 8 months, maybe 9 months to stabilize 293 apartments. During that period of time, once we'll reach a certain amount of occupancy, we're going to start talking to the brokers about selling the asset and finding buyers for it. And at that particular time, when we sell the asset, we'll disperse all the proceeds back to the investors. And so usually that's how it works. So that's a long-term project. Some of our projects are a year long. Some of our projects are 18 months. It really depends.
Right.
And so we cater it very differently to a variety of investors.
Part of collective bargaining of what we spoke about before is being able to really have heavy negotiations. So due to the fact of the size of capital that we come into some of the deals with our partners, our developing partners, we're able to negotiate those kind of things. We're able to negotiate, when we're going to exit and when would be the right timeline for us and not, that is our typical horizon. Those 3 to 4 year exits is what we're always focused on. And those are the type of deals, when we enter into the deals, we make sure that timeline matches to that deal.
And how do you determine the the proceeds? For example, let's say it's a condo building, right? And it's a 4-year term, right? So from inception to selling it off. And then you're telling your investors that they're going to make, let's say, 20% net, right?
A year.
A year, right. So how are you making that net on the interest of the money that is invested, that the builder is paying interest on that money, or are you counting on the appreciation of the property, the property appreciating, and, you get it for this amount. Let's say you bought the land and the construction cost is this amount, and then you build it and then you sell it.
Absolutely.
And so then there's a profit margin there.
Yeah, absolutely.
So what happens if the market goes down?
So if the market goes down, and it can happen, then you're not going to make 20% a year. You're going to make less.
Right. So it's not guaranteed.
There's never guaranteed.
Of course.
So we take into account a couple of things, right? We look into a project. Let's assume we think the project's going to cost $50 million, right? We deploy maybe $20 million into the project as equity, as partners in the deal. Project commenced. We're assuming that numbers will stay where they are. Maybe they'll be a little bit less. Maybe they'll be a little bit more. But we have some dynamics there, right? So we're assuming, let's just say, that the project will sell for, $80 million, right? Creating a $30 million profit margin on $20 million invested. And then there's fees along the way, and part of the fees that we take, part of the fees the developer takes. And eventually the investor will end up, according to our projections, maybe 20% a year. Okay, into this example. We also do a plan B. What if the market takes a turn? What if, God forbid, another pandemic happens? What if the economy tanks? What if something could happen in the course of 3 years?
Sure.
What if the project goes longer? What if the project needs more capital? So everything is being addressed. At the very core of the conversation that we're looking at, every transaction, at the very core, the question always remains, what is preservation of capital? How much risk are we willing to take if the market changes? Can I lease the property? I'm going to have a beautiful building, that's for sure. There's so many guarantees to the bank, by the builder, by everybody else.
Sure.
But will I have the ability to lease those units and keep my head above water, cover my expenses, cover the mortgage? If the answer is no, and God, you'll be surprised how many times the answer is no, we don't go into the project.
Right.
So I always have a plan B, because I don't have a crystal ball.
You don't?
I don't. And I don't know what's going to happen in 3 years. I can project that if things will continue according to how they continue, right, then things will stay stable. I'll be able to sell. I might have enough pre-sales, right, to prove my theory and things of that nature. We enter into a project in downtown Miami. It's a great example. We only entered the project. The project had 310 condo units. At 310 condo units, 219 hotel units at the center of the building, and some medical office. We've entered the project when 95% of the unit, in that particular case, 95% of the units were actually pre-sold with deposits between 30 to 50%. Why do we do those things?
Why do they need you if they've already pre-sold the units?
Well, pre-selling the units doesn't mean that they have all the entire equity. They still need a lot more. They still need a lot more equity. So the way it works is you have a construction loan, use some of the proceeds from pre-sales, and then you still need to bring in a certain amount of equity, which this is where we participate. And so we reduce the risk when we do stuff like that, right? We have 95% of the units, and most of the units are 30 to 50% down payments. Well, you reduce the concept of, will I sell the property or not? Am I right? When you have a serious, strong brand, such as the brand that we have, in that particular case is the SLS, then we reduce the risk of who's going to be managing the hotel component of that building. So we always look at things from a standpoint of not what's my highest return. It's great to have those returns. And many times our projects actually outperform because we're conservative. We take a little bit of a conservative approach to things. So many times we outperform. We might say 20, we end up with more. But we also take the stand that the market can shift. And we are focused on the worst day, not the best day. The best day will take care of itself. We'll make more. Nobody's going to complain.
No.
But on the worst day, can I maintain the operation? Can I keep my head above water? can I keep it for a couple of more years until the market turn around and stabilize again? If the answer is no, we're out. If the answer is yes, then we get interested.
All right.
It's also about the positioning, right? So we have the 3 different ways how we deploy our capital. So some of the ways that we make sure when we enter into a project and we analyze it, depending on what the market is doing, like it's where do we position our capital in those stacks, in the above the numbers, and then the preferred equity position for us has been something that we've been doing more of this year and last year, because it's a different kind of position. It affects the capital differently. So we always make sure when we're looking at deals, we really figure out where in the stack do we want to put our capital according to what kind of deal it is and according to how much risk we're taking. So those are also very important parts to take into consideration. How do you position your capital?
Right. And so in the grand scheme of things, as far as investment goes, would this investment be considered low, medium, or high risk investment?
That's certainly a loaded question because, we always consider that investment in alternatives has a certain amount of risk. We can de-risk by having all the stops and belts around an investment. I would say we're medium to low.
Yeah, I think so.
I would say we're medium to low.
I would say medium just because it's a little untraditional. And I could see how it's kind of like, teetering on low because you guys have such a vetting period. I'm sure that you get a lot of deals across your desk on a daily basis.
800 a year.
800.
Probably even more.
Yeah. So going through and picking the best ones. So how many investments do you guys have going now, like in different phases?
Well, since inception, Astor managed a 26 project. We have 18 running right now. Several of them are sort of like the very, very last part.
Right.
And so
do you have any that, so I guess if somebody's looking to invest with you, do you have like, okay, this is open and then it's going to close at this point and then it starts to go into the, the seasoning period where it's like, and then it gets to a point where, okay, you get investment for this project is closed, but now we have this one over here. Like, how do you
So I'll explain to you how it works.
Yeah.
So
how does it work?
Yeah, so how does it work? We basically look at tons of projects.
Right.
Our analysts are up to here with projects. We vet them. We don't just drop everything in. Okay, well, we have over 800 requests a year to participate in projects as partners. We say no to about 98% of them. We give offers to maybe, 16, 20, 22 projects a year. We close on 8 to 10 on a good year. So the vetting process is very, very tough, right? The ones that we choose really do have to stand out, really do have to, because all we do is we assess the risk, right? The risk is always there, right? So we chose a project. We negotiate terms. We negotiate all the stuff that's important to us on the legal terms. We sign it up. We create the joint venture partnerships. Then we go out and we pitch it to our investors. And we tell them what we think the project is, what we think the risk associated with the project is, where that we think the exit is going to be, what's our projection of the return. For example, we're working on a project right now. It's 220 units, rental, right at the gateway of Disney, one of the largest employer in Florida. We underwrote the existing rents, the projected rents lower than the market just to stay on the safe side. We're working with a wonderful, wonderful group that's been around, third generation builders, been around for over 54 years, built, I'll probably say over 20 million square feet, multiple times they've done projects like this. We're going to be the major group, major owner of this project. And then eventually we'll come out and we'll explain the project, we'll explain the the concept of what we're looking to do, how long will it take us to build this project, what's going to be the intended cost, and then eventually where we're going to get capitalized, who's going to be the bank, who's going to be the capital, how much capital is coming from our partners. And then that's essentially, that's our presentation to the investors. The investors will make their own decisions. Do I want to invest into a rental project right now in a place like Kissimmee? Is that a good investment for me? What are the fundamentals of Kissimmee, Florida? Is it a growing market? Is Orlando overall a good place to invest? Do I want to be in Florida or do I not want to be in Florida? What's the minimum investment size and so on? So going back to the same guy or lady with $500,000, right? She might say, look, I can drop my money and sign a big loan of $1.5 million and buy a condominium on Brickell, or I can take a chunk of it and maybe put it into that investment. Returns are probably going to be over 20% a year, according to our projections. And because it is conservative, maybe we'll see a little bit better. Obviously, there's no guarantees, right? But the market has been set, right? The market has been set. The demand over there is super strong. So we have enough of a conviction that this project is good. Why? We chose a great geographical location. We chose a great asset class, multifamily rental. We chose a wonderful partner. This is 54 years of experience, 500 people working for those people. I mean, we're talking about some major group.
Right.
Below the radar, individuals that are, we're inspired to start working with them. We've been in conversation with those guys for over 2 years. Multiple projects we looked at together. So that's the kind of processing, the kind of vetting that we do before we come in and recommend a project like this.
Right.
And when we recommend, we don't just say it. We put our money where our mouth is. Marika and I put our capital, our family's capital, into the project. We go in first, and then we offer it to our investors. That's the difference.
And what's the term on that? Like, let's say that's the one that you're raising capital for right now, right? The one in Orlando?
We're going to be going out to raise capital soon,
Okay.
yes.
So if somebody wants to put X amount of dollars in, how long is the hold?
So here's a great example. In this particular project, our developing partners believe that they'll finish the project within 2 years, stabilize within another maybe 4 months to 6 months or 2.5 years. We're projecting 3.5 years. Why are we projecting longer? Because things happen in the world, right? So I'd much rather say to our investors, listen, we're looking at the 3.5 years, not the 2.5 years, and providing that we'll stay within the time span or sooner. According to our projections, the investors are going to be making around, maybe around 74% on their capital, 21%-ish a year.
Compounded. Okay.
Year of year. So 3.5 years, 21%. So that's usually how it looks. So going back to your investments, $100,000 will likely generate around $174,000 back. $100,000.
And is it compounded every year? Like, let's say,
it's not
the first, it's not compounded.
It's not that. It's
Okay.
not that. This is pure equity deal. It's a pure equity deal.
And then what if, God forbid, something happens and the investors' situation changes and they need to get their money out? Like,
so
what happens
we have
then?
over 300 investors on the retail side. Remember, we're backed by a very large public company as well. So we have over 300 investors, and over the course of, call it now, almost 7 years, we've had a couple of situations by two investors, different projects, different individuals, that had a situation then they wanted to repatriate money back sooner. And so what we've done in the middle of the project, we've sent an email, quiet email between all the other investors of that particular project. Our investors get a quarterly report, so they always know what's going on, sometimes monthly report, but they always know what's going on. And they said, hey, there's an opportunity. One of the investors is looking to come out of the deal at this stage. Who's interested? We got so much response, so much positive response, that we can always repatriate capital and bring back the money to the investor if they run into some tight spot or anything like that.
What does repatriate?
Repatriate.
Repatriate. That's a good word. Repatriate. Is
Repatriate,
that it?
Yeah. So in other words, return the money back to the investors.
Return the money back. I'm a wordsmith. I love words. So anytime I hear a word that I don't know, I'm like, wait a second. That repatriate.
Yeah.
I'm going to have to look that up.
Sure.
It's the word of the day, folks.
Repatriate.
Repatriate back your capital. It's an important concept to understand. When you invest, the first thing you want to know is, am I going to get my money back?
Yeah.
Will I repatriate my capital?
Repatriate. Okay. All right. I like it. Doesn't happen much that I find a word that I don't that I know that I don't know. I'm going to have to use that on my father this weekend. I'm going to slip that word into a sentence this weekend with my dad and see if he knows what it means, because we're always like wordsmithing each other, especially in my family. My stepmother's from El Salvador, right? So English is not her first language, although she speaks perfect English. Yeah. But, obviously my father and I are American. Words. We're like fourth generation American. So my house is like Que Pasa USA. And when me and my father, because we're like two peas in a pod. So whenever we're trying to discuss things in front of her, but we don't really want her to know what we're saying, we speak really fast and we use very big words like English major words. So we can get points across very quickly and in front of her. And it's funny because after 30 years, I don't think that she understands that we do this, because we just talk really fast and we use really big words, and so she doesn't get it, and and we've been doing it for years. You just gave out
the family secrets. Right?
Yeah. Listen, believe me, my family doesn't listen to my podcast, so I don't have to worry about that. So anyways, listen, I think that this is a very interesting concept. I'm so glad that I had you guys on the show today. And tell me, like, what are the next steps? If somebody is listening to this podcast and they're like, wow, I want to learn more about this, obviously they can contact me.
Of course,
and I guess that would be the next step. Contact me, listeners, and I could walk you through. But let's just say they do contact me, and I kind of know the answer to this question, but I want you guys to talk about the courting. Like, somebody's interested.
Yeah.
How do you walk them through? What do you do with them? I think that you have some Zoom educational meetings that you put them on, or what do you... Tell me your process.
So first of all, it's always very easy to reach us. Of course, any listener of yours can reach out to you first. The easiest things would be to just set up a direct call with us. We're always happy to speak to people, whether it's face-to-face. If they're local, we're happy to do that as well.
Love it.
We're happy to jump on a Zoom, a phone call, anything that is the most suitable for that specific investor. Now, on top of that, we also have our own specific designated investor relations department and team that handles and manages anything that has to do with helping you with documents and filling out things and really getting you set up, introducing you to the investor portal that will make everything very streamlined and easy to use and access. There's an app, so everything is very streamlined and available for anyone that works with us. We also make sure that we have our ongoing webinars and Zooms, whether it's educational or pitching a specific deal. We're always in the face of our investors. So anytime they have a specific question or they need updates, it's either us or we have, like I said, the investor relations team as well. So all areas, whether it's social media access and phone calls, we're always available. So that's the important thing. Like, we really want to make sure that we are very accessible, because there are a lot of situations out there where people don't feel that and they don't have that. And we have a lot of, investors where when we'll be, for example, at an event or environment, they'll see us, they come over to us and we build a friendship. We're building, like a family interaction here.
Let's go over the steps. Step number 1, reach JoAnne. Express your interest. JoAnne will let you know when our next investment opportunity happens. You'll be invited to the Zoom. Listen to the Zoom. Educate yourself. Ask questions on the Zoom or off the Zoom. If you're interested, what we do immediately after depends on the investment. Without complicating things, not every investment is right for everyone. First, we have accredited investors, and then we have non-accredited investors. So you need to know exactly where you are. JoAnne can help. We can help with that. Assume that you are a fit to the investment and you would like to participate. You state the amount. We take you through the process. JoAnne will help. Our office managers and the investor relation people that we have in the office will help take you through the documents. The documents essentially are going to generate essentially who we are, what's our relationship, how's the partnership works between us, what is our responsibilities, what's our benefits. You're also becoming part of an investment that will be all the documents, all the due diligence. You'll have the data room. You'll have all the good stuff. We encourage you, the investor, to go and talk to your attorney. We encourage you to speak to your real estate professional, we encourage you to speak to JoAnne. We encourage you to find out as much information as possible and do your own due diligence on the documents that we have and on your own. Once you feel comfortable with everything, then we'll take you through the series of documents that we need to execute in order for us to become what we call the collective bargaining. Our check size become large because there's a bunch of us doing it together. You place your capital, we do the same, we take the exact amount of risk, and then we enter the project. What we do during the lifespan of the project is we make sure that we have our team on the ground following everything that's going on, collecting information from our operating partner, collecting information from the professionals that we send to the project, and then we give you the information on a quarterly basis. And in between, whenever we have breaking news, we topped off the project, we reached the CFO, we got into the ground, we closed on a construction loan, or anything around those lines, you'll be notified as well. Sometimes it's 2.5 years, sometimes it's 3 years. We'll be in communication a lot. You can always reach us, you can reach members of our office, and if you need to speak with me or Marika, we'll be available as well. That's usually what it looks like. At the end of the project, we'll sell the asset, we'll do the disbursement of capital, and then you'll get your share. Then hopefully you'll redeploy with us because we'll be making lots of money together.
I like it. I like that you could actually go and look at the project. If it's in Orlando,
Kick the bricks, absolutely.
yeah, you if you're in, let's say you live in South Florida, we all go to Orlando at least once a year, once every couple years. Mm-hmm. You could drive by and be like, oh, I invested in that. And I don't know, there's just a tangibility about the whole thing that is refreshing, especially in this world that we live in now where everything's like an arm's length away. Yeah. So
it's pride of ownership.
Yeah, I like that you could touch it and feel it and meet with people. And, I'm old school that way. The first thing, when we first started talking and I found out that you guys were in close to me, I'm like, let's meet, and that's what we did. We met. And I don't know.
Spot,
I need
Pura vida.
Yeah. And I need to meet with people.
There's gluten-free avocado toast out there.
It is. Listen, I love me some pura vida. I love it. But okay, well, I think, is there anything else that you guys want to mention while we're on the clock here? We covered a lot.
I want people to reach out to you and to express interest.
I want them to too.
And I want people to ask questions and learn and find out more.
Yeah.
And not every time you reach or get on a Zoom with us, we are expected to invest. We fill up fairly quickly, thank God. Yeah. We have more demand than supply. In other words, we have less project to offer than the capital that we have to deploy. And so
that's a good problem to have.
It's a good problem to have. So it takes a couple of times to get comfortable with us, to do your background search. Take your time, educate yourself, but get in the motion. Get going. Speak to JoAnne.
Yeah,
I'd love to see you there.
Just do something. So many times people have contempt prior to investigation. So they hear one little thing and they're like, oh, I don't like that, and then, but it kind of is like an excuse for them not to scratch the surface. And it's one thing to, look at everything, put it all on the table, have your attorney check it out, have somebody read through the contract, answer your questions, and then decide that it's not for you. As opposed to just saying, oh, I don't understand that, so I don't want to do it. Well, if you don't understand it, then figure it out and then decide. I just get so annoyed when people have that contempt prior to investigation.
That's what we're here for. Yes. Anything that anyone doesn't understand, that's what we do. Live, breathe, sleep, real estate, and we've been doing it for a long time. So that's okay. That we have a lot of people that they're not real estate investors or savvy real estate investors, but that's exactly who they look for, is who's going to watch out for my capital and be on top of things that I don't really understand. That's exactly where we come in.
Yeah. Well, I know that for me, I've been doing this for 20 years almost, or I think, I don't know, 19, 20, 21. And it's an ever-changing market.
Yes.
And as a real estate professional, I'm always looking outside of the box to see what other options can I bring my clients? Because if I don't believe I can't sell anything that I don't believe in. So, when I sit down and I work the numbers with my clients and we realize, oh, you're going to be lucky if you can get a 3 or 4% cap on something that maybe 5 years ago you would have gotten a 7-8% cap. It's like, it's hard. It's hard for me to push that. So then I'm forced to kind of see like, well, what other options are there? And then that's how I came up with you guys. And also I'm very interested at this point in my life in learning more about wealth building. It's one thing, like for a long time, I was like, how do I make the money? And now I'm like, how do I keep the money? And how do I make sound investments? Yes. So then I kind of have gone down a rabbit hole, and that's where I find I'm kind of taking the podcast with, being more educational on wealth development and wealth retention. Yes. And a lot of people just, they don't know. So that's where we're at.
That's for the next podcast.
That's for the next podcast.
First we make the money and make lots of it. Then we find ways to keep the money.
Exactly.
And save on taxes. Yeah. Then we think about where we're going to place the money next.
Yeah, exactly. So listen, both of you, thank you so much for taking the time
Thank you, JoAnne.
To spend with me. And for those of you listening, Buying Miami is anywhere you look for podcasts. So it's on Spotify, Apple, Amazon, and a bunch of other platforms that I am not even sure where, but apparently we're there. And we're going to wrap it up for this time. Thanks again for coming and being with me. And we will see you guys next time on Buying Miami, Life, Love, and Real Estate.